Hey everyone, it's Uzi Hussein with H2 Team Orlando and Keller Williams at the Parks Realty, and I am so excited to bring you this recording today. I have a very special guest. I have with me Dwayne Gale with Edward Jones Financial. He's a financial advisor. Hi, Dwayne.
Hi, good afternoon.
Thank you. Good afternoon. And just a little introduction. So Dwayne has been in the industry as a financial advisor for just around 10 years. And I believe half of that time you've spent with Edward Jones. Would that be correct,
Yeah,
Dwayne?
that's correct, right at 5 years.
Awesome. And his office is right here in Maitland, Florida, for those of you who are in the area. And prior to that, Dwayne was with the Navy.
That's right. That's right.
Did you play any
I was
sports?
with Wells Fargo Financial Services for a while, but prior to that, I was pretty much in the U.S. Navy.
Fabulous. Did you play any sports for the Navy?
I did actually. I played basketball a lot. I traveled with the All-Navy basketball team for a little while there, and that was
Awesome.
exciting. Yeah.
Awesome, man. That's great. Hey, so Dwayne, wow, what a wonderful time to have this discussion, right?
Wonderful. Yes, it's been the most extreme volatility we've seen in a short period of time, unprecedented, much more significant drop than 2008 in that period of time. So 2008, the market dropped farther, but it did so in a more protracted way.
Right.
So this was just a kind of a very acute drop that was extremely significant. We saw values decline with a rapidity that we've never seen. So just really a good time to be serving people, good time to be prepared to answer questions, a good time to be calling every single person that you knew, every client that you knew, and kind of talk to them about what's happening, what they own, and why do they own them.
Right, right. So I'm glad you said that because, we've been doing that on the real estate end as well, like touching base with our clients. And you and I were talking right before this call started today. And, our activity, while it may have slowed down a little bit, we're still seeing steady activity. I mean, our market numbers, week over week trends are looking very promising. We're seeing, new listings coming on the market. We're seeing actually an increase in the number of properties that are going under contract week to week. So those are promising numbers. And so I wanted to ask you, if you could lead this discussion and basically, telling us, where we are today. What are some conversations you're having as far as what are you sharing with your clients as to, what to invest, what not to do, or what is your spiel right now?
Sure. So basically, essentially right now, it's just a great opportunity to hit the reset button and do an assessment of who you are, what your long-term goals are, and are you on track to achieve those goals? So we do not believe in making knee-jerk reactions based on what the market has presented you. We do believe in just decisively looking at where do I want to be in 5 years, in 10 years, in 20 years, whatever your horizon is, where do I want to be? And am I on track to achieving that? That starts with
taking on a long-term approach.
A long-term approach, and more importantly, a risk assessment approach. So look, if you're 20 years away from the time you'd like to have a work optional lifestyle, then did this period of time stop you from achieving that dream in 20 years? It should not. It should certainly not. 20 years is a long time from now. We're going to go through many more investment cycles during this period of time. Now, that's that person, right? But what about someone who says, yeah, but I'm only 5 years away? Well,
sure.
That person, if you have a 5-year horizon on when you'd like to be, I use retirements in air quotes now because a lot of people don't actually retire. They just decide to stop working because they're going to do something they've always wanted to do. So if you were sub 5 years from, living kind of a work optional life, then we should have already assessed what your risk comfort level was. We should have already been in ongoing having meetings to discuss, hey, here's your risk level right now. Here's what you own right now. We should be rebalancing as needed, which is to reduce the risk in your portfolio and make that risk commensurate only with the amount needed to achieve your goals.
Mm-hmm.
We should already have been doing those things, and we were. So it's really just a matter of, what do I want to achieve? When do I need to achieve it? And am I acquiring the long-term investments that will achieve that goal? That's what we're
Right.
doing now. And that the market has presented some fantastic opportunities. There's some great companies right now that are effectively 30% off, 20% off. This was an external shock to the system. So a lot of these companies were rolling right along, great balance sheets, quarter after quarter positive returns, and the demand for their products and services have obviously been completely removed. Through no fault of their own, they cannot sell
Right.
their product. So is it an opportunity to acquire some of those companies? Perhaps if you have cash, if you have a risk comfort level that's appropriate for, then yes, it's an opportunity to pick up some investments at a good price if you have that ability. So yeah, that's what the story we're sharing with clients, because that's the story. There is no other story. That's the one that makes sense.
Now, this is a great segue, because one of my questions for you obviously is about, where are the opportunities now? Granted, like you mentioned, there are companies that have had year-over-year positive gains, and we're talking that they're currently valued, or 30% off their normal sticker price, let's say. And so there are certainly certain sectors, whether it's airlines, anything hospitality related, retail related, so forth, where I'm seeing some opportunities. But just what are some areas that you would recommend someone who, let's just say, is medium in terms of their risk averse, is maybe still has some longevity in before they can have their as you said, work-free living lifestyle.
Right.
So what would be some sectors that you would suggest or recommend?
Sure. So we always want to avoid naming individual companies, right? Because there's the high risk level there. Someone watching this video may say, "Oh, he said to buy
Yeah,
500
sure.
shares of that." I'm going to do. So we're not going to do that. But what we can do is say there are sectors that you just named, namely the travel sector, tourism. They've probably taken the biggest brunt of the pain here, because people are just simply not using those services right now, are unable to. So we're seeing some great opportunities there. We're seeing opportunities in commodities, obviously underused right now. And there was a OPEC, basically
Crude
a trade
took another
issue.
hit this morning, right? Crude took another hit this morning.
Absolutely. Yeah, we saw a lot of issues with crude oil, basically between Russia and OPEC having some issues with overproduction and trying to negotiate a deal with that. So there's deals in multiple sectors. There's opportunities. What I would say though is, it's right now more than anything, what the average retail investor needs to know is, your success as an investor has a lot less to do with you being in the right sector, and a lot more to do with you investing a regular sum of money in regular increments without fail every single month or every single year consistently. We find that consistent investors outperform investors that are more looking for the stock of the day or the opportunity of the month. The truth is, if you're buying high quality companies with a track record of sustainable results over a long period of time, it's the closest thing to a free lunch in investing. Rebalance your portfolio, make sure you have the appropriate mix of stocks and bonds for your risk level, and make sure you're investing consistently, and you're going to succeed. Now, that's not exciting, right? It's much more exciting to talk about the individual stock that you should pick up 1,000 shares of right now.
Oh, sure. Right.
But the truth is, long term, you don't need to take on that level of risk. You really,
Sure.
to achieve your goals, you don't need to take on that level of risk.
Absolutely. So, and to use a real estate parallel here, basically what you're saying is, so if you're an investor, a real estate investor, for example, you could do one of, a number of things, obviously, but a couple of the more popular ones, mainstream, are you have those guys who would basically acquire assets, income producing assets, and hold on to them and build a portfolio of income producing property. And that's usually a long-term outlook.
Right.
Versus, say, someone who's in the business of doing rehabs and doing flicks and fix and flips, right? Those
Exactly.
HGTV shows.
Exactly.
Um, and
Yes.
while that happens, that certainly has a different layer of risk associated with it, and different goals, and more of a short-term play versus the long-term play, and holding on to say an income producing property, whether it's residential or commercial, and then not only is it going to appreciate as an asset value, but at the same time it's also bringing you the financial income opportunities, right? So I guess the big question that I would love to have you answer is, Dwayne, are your folks still investing right now? Are they, are people are people like saying, hey, we're going to pause, or are they saying, no, let's just keep investing?
Yeah, absolutely. So I will answer that, and I'll also agree with you 100% on the similarities with real estate and Wall Street investing. They are quite similar. I use real estate as an example when I'm having my meetings with clients, and the example I often use is, look, if you bought a great house that works for your family in a really nice neighborhood with really good schools and great infrastructure, just a great place, and you've always wanted to live there, and you've been living there and everything's been great. You go check the mail one day and your neighbor says, we're selling for half. Didn't you hear? The market's dropped and we're selling for whatever we can get our house for. Okay, so when you go back home, do you say to your partner, we got to sell for half? Didn't you hear the market's dropping? Or do you say to your partner, hey, how much cash can we get together and buy that house? If
Right.
the answer is get cash together to buy that house, we apply those exact same rules to investments. If you're acquiring great companies, track record of profits, great products that people like to use, quarter after quarter, they have relatively consistent sales and their management is good, why would you sell them because of an artificial shock to the system?
Right.
You wouldn't sell that house because of
Sure.
an artificial shock. So we apply those same rules. As far as what my clients are doing, you know what? My clients are staying invested. They're staying invested. They're staying in the market. We are rebalancing. So we
Hmm.
are assessed. We're conducting regular meetings by phone and by virtual, but we're looking at client portfolios. We're rebalancing to kind of make sure risks are in line.
Right.
Prior to this, of course, Wall Street was at an all-time high. So
Hmm.
a lot of people probably had more stocks than they were comfortable with necessarily, right?
Hmm.
We know we rebalance regularly, so most of our clients were kind of right in line where they were supposed to be. But a shock to the system like this really does make you assess. Hey, wait a second. Uh, how much risk do I absolutely need to take to hit my goals? Okay,
Right.
just that much? Okay, let's just take that much, right?
Right.
And so that's exciting to see. But I do have a good bit of clients that are calling and saying, I was actually really proud that I had quite a bit of calls from clients saying, hey, I've got some cash. I've got a little bit of cash I've been kind of stashing away. What do you think about this company? What do you think about that company? And that really made me feel good because that means I know I've been doing the right thing for the past 5, 6, 7 years. I've been giving good advice that we should buy these opportunities because look, these Wall Streets always come back. It's never not.
Right. So now, just to ask you along those lines, now, as I've been just, monitoring the numbers in terms of how the Dow Jones is doing, and it seems to me that the Nasdaq, ever since this thing started, say 2, 3 weeks ago, seems like the Nasdaq seems to be bouncing up better than the Dow in terms of gains. Is that an accurate assessment, or am I not seeing something here?
Yeah, I actually was talking to a colleague of mine about that. That the tech companies seem to be rebounding faster. And that actually makes a lot of sense if you really kind of take a macro look at it, because they're generally not selling a product that requires inventory. They're typically selling a service that you can use at home, or you can use via remote regardless. They do not need a large sales staff necessarily, or, shipping, logistical forces behind them, infrastructure behind them to do these things. So it actually does make sense that they're able to rebound quicker. That's now, right? We don't
Yeah.
know what this looks like in 3 months, 6 months, a year. Hopefully that trend will continue where all the Dow, the S&P continue to rally out of this, but we don't know. This is uncharted territory. I'd like to think we're out of the worst of it, but I am reluctant to say that we don't know what this looks like for quarter 2 and 3. But we did notice that with the Nasdaq, yes.
And hindsight is 2020, right? So we should have called you a long time ago and said, "Hey, we should have bought Zoom and Cisco back when it was X," especially Zoom, right?
Everybody. I have a client said, "Yeah, I should have bought Netflix 10, 12 years ago." And I said, "Well, look, let me ask you, if I would have offered you Netflix 12 years ago, if I would have said, hey, there's these people that are mailing the DVD to your house and you watch it and mail it back, what would you have said?" He said, I would have said, "That sounds silly. I'm not doing that." Right.
Sure.
It makes total sense now because
It's like, I'm going to go to Blockbuster Video or Hollywood Video.
Exactly. 12, 14 years ago, you would have thought, well, that sounds really strange, because it would have been a new world.
Right.
No one has a perfect vision for the future, but if an opportunity presents itself that makes sense and you're prepared to take on a little bit of risk, the risk takers in that situation did really well. And if you took a little bit of risk with a smaller percentage of your portfolio, I think that's a great idea.
So not to put you on the spot, and I know you have to be very careful about what you recommend.
Sure.
But as we move into this new normal, obviously with everything that's happening in the medical, is pharma a good bet?
Yeah, so look, I have a few clients that are really trying to capitalize on whatever opportunities exist in the pharmaceutical industry, the pharma space. What I would say a person who's interested in that should do is rebalance their portfolio, their existing portfolio. Assess how much cash is left over. Sit with their financial professional and talk about what opportunities, what specific companies exist in the pharmaceutical space that, based on risk, right? When we adjust for risk, what can I afford to put cash to work now, and really kind of take inventory of yourself. Are you speculating? In your industry, that would be, am I buying a flip house in an area that may be good in 10 years? I don't know. Or am I buying a high quality stock that happens to be artificially down right now that I'm going to hold for the long term, and hopefully it will be significantly more valuable than it is? If the answer is the latter, then that's what you should do. If the answer is, I'm taking a large chunk of cash that I really can't afford to lose, and I'm going to speculate on a pharmaceutical stock because that company may be the one that comes up with the cure for the coronavirus, that would be a mistake that I do not think people should make. I would not do that. But if you're looking long term and you're using a small percentage of your portfolio or cash you had on hand and you're assessing for risk, yeah, I see nothing wrong with that. And we have clients that are doing that. That's fine.
Sure, absolutely. Hey, let's take a little pivot towards the unemployment numbers. So obviously we only know based on what's been reported, right? So last week I had tuned into a couple of other meetings, and I don't know if you know this, but I made a note. Did you know that last week, apparently, or I guess leading up to last week, according to Google, the most there was a 5,000% increase in the search word furlough. What is furlough? That's quite incredible, right?
That's not shocking. Yeah.
And so in that same webinar, I also heard about a very interesting point that someone made, which is that, as of like last week ending, I believe the numbers were around 22 or 25 million, right, for unemployment.
Right, right.
But they believed that because so many people have been unable to actually get in and file, that number is potentially, maybe 20-30% higher than what's being reported. Would you agree with that scenario?
I would. It sounds very reasonable. Right now, a lot of this is so fluid because the unemployment numbers that came out from the federal government earlier this month really didn't reflect the total number of people that had applied or had been attempting to apply.
Right.
So we'll certainly get a more accurate look at the employment picture towards the end of this month.
Right.
There are a couple of things that are definitely give us pause, right? That's quite sobering. So one, we know that the unemployment rate at the height of the Great Depression was right around 25%. And it's not unreasonable for us to expect this current financial situation, economic situation, it could eclipse that.
Wow.
Or at the very least, it could meet that. We could see 20-25% of Americans of working age unemployed. So that really sobering data there. I certainly hope that doesn't happen, but it could. So the unemployment numbers are definitely jarring. We've not seen these numbers. So to put that into some perspective, 2008, if we reflect back, the unemployment rate really never got past 10%. It was around 10% at its peak, 10, 11%. Where we may be significantly higher than that now. The latest estimates I read were probably around 14% now.
Okay.
So we could be looking at, by the end of the month, 15, 17.
Wow.
20%. So that would be higher than it was at its peak in 2008.
Certainly, yeah.
Which was a very painful time for a lot of people. A lot of people were suffering for a long time behind that. So just now is really a good time to assess, your investments, assess what the CARE Act offers for you in terms of what benefit you could, if you had to utilize the CARE Act to access any retirement assets you may have accumulated over the years. It's a good time to see, did I follow the rules that I should have been following before? Did I hold on to 6 months to a year's worth of cash for near-term emergencies? This absolutely would qualify as a near-term emergency. If your income suddenly stops like this, how long can I go with the cash that I have? The industry standard is 6 months to a year.
Right.
Is the amount of cash you should have on hand. Meaning I could pay my normal bills, so the roof over my head, my car, food, gas, I could pay that for 6 months to a year.
If you didn't have any other income coming in, right?
If I did not have any other income coming in, our lives in terms of the basics would continue. Hoping that rule of thumb was followed. Unfortunately, we know that Americans haven't been the best savers in the good times.
Sure.
So, but we did see the savings rate was higher than it had been prior to this downturn. The savings rate was about 8%. In America, Americans were saving about 8% of their incomes on average. That's higher than it was prior to 2008.
Okay.
So there were some lessons learned apparently there, but it's still, we ought to be saving more.
Sure.
So yeah.
With the unemployment, certainly certainly some sectors of the economy have been hit much more harder than others, as we know. We don't know what the recovery period is going to be, whether it's, let's just say if best case scenario is that they find a vaccine or something so that people can safely return back to work in the next 3 to 6 months, let's just say, as a best case scenario. But then we're also hearing that in terms of a the outlook is we could be in this for about 18 months, right?
Sure.
Where do you see the recovery in terms of how long would it take to recover, if it's best case and if it's worst case? And by that, what I would like to sort of touch on is, for example, back in the 2008 housing crisis, that was truly a housing crisis
Right.
market. It took, I was in that shift, and I was early on in my career, and we were doing short sales and foreclosures and bank-owned properties and so forth. But we started to see, we had a couple of years of real solid pain, and then we started to see some recovery, starting with some cities and then lagging. And it really was, let's just say it was a 7-year period, potentially, from like around 2008 to 2015, before everybody, all 50 states were out of the doldrums, if you will, right?
Right.
So
Right.
in this case, I guess my question would be, if this is only a 3 or 6 month best case scenario, that later this year, we should be all back to, maybe with some new changes into the, how we conduct ourselves, but that for the most part, things are back to normal. Miracle vaccine comes out, or antibody testing, whatever it is that they do, that we all are back. How long would it take to recover? And then if it's going to be 18 months, how much further do you think it'll be before we'll sort of recover to where unemployment gains and everything is looking, more optimistic?
Yeah. So everything we've heard from the administration has been that, look, if we have a vaccine that's proven, it's tested, field tested, that works, that it would be months, not years, to recover, because obviously you would want to scale that. You would want to scale testing, and a significant increase in the amount of testing that's done. And now you'd be accompanying testing with a vaccine, or or some sort of cure, right? So that would equal a months-long recovery. That said, look, when you're talking about coming up with a cure for any illness, the truth is we don't widely distribute any drug well worldwide. There's no drug that has proven itself to be extremely useful in any acute illness that is widely available to everyone who needs it.
Right.
That doesn't happen, right? We have pockets where it's doing really well here, but it's not doing well here. So the notion that we would be able to distribute that drug to every American, all 330 million of us, or let's say only 25% of the population, 25% of the population doesn't need it at all. They would get symptoms, but they'd be okay. So you're still talking about tens of millions of people would need a dose of this vaccine that we do not yet have.
Right.
So not to diminish the idea that we could have that, just I think a more appropriate outlook would be that we could be in this for a long haul. Even if we have a vaccine, we could be in this for a long haul. What does that look like? I don't think anyone actually knows, but if I had to guess, I would say it probably sounds like the first step is a serious increase in the amount of testing that's being done.
Mm-hmm. Right.
Where tests become much more widely available. I've been doing a lot of research on the quick test, where the results come in minutes, not days.
Mm-hmm.
We probably need a significant amount of those, much more than we currently have available. And just a lot more self-quarantining, where people are able to test themselves. Okay, I have symptoms and I have tested myself. I'm going to self-quarantine. These could lead to some good results. I think we could definitely see us bending the curve, and which would have good economic results there, because essentially then everyone who would be out of their home, you would assume, would be
out of their home.
Safe out of their home. You're supposed to be out of your
Right.
home. You do not have the disease. You do not have symptoms right now. Because we have so many tests that makes a lot more sense. That said, we're nowhere near that right now. We do not have the amount of tests. The last reports I read are that we're conducting about 100,000 tests a day, which, as I understand it, we should likely, the goal is to get to about 4 times that a day.
Sure. Yeah.
So we're not there yet. Look, in terms of a recovery, I've heard 3 options. A V-shaped recovery, which is what you described. So
Right.
quickly down, quickly up.
I'm always the optimistic silver lining person, you know?
So we all want that one, right? The V-shaped recovery. Then I've heard the U-shaped recovery. Now that makes a lot more sense given what we know now. Do you flip a switch and the economy goes back to where it was in February? Probably not. The
Not for a
U-shape
while.
for a while. So the U-shape seems to make some sense where it kind of is a slower turn up. And so right now, look, the jury's out, but I would say the U-shaped recovery seems to be where we're headed. But the V-shape
Gotcha.
is also possible. The V-shape is also possible. If in your scenario you describe where a vaccine is found and absolutely works, and we can scale the distribution of, I don't see why we couldn't have a V-shaped recovery at that point. Sure.
Sure. Great. Hey, and not to put you on the spot with opinions and stuff, but I was just, just trying to get a sense of what in the financial advisors world, what types of conversations are going on. Listen, thank you so much. You've given us a lot of great information here today. I just have a couple more things for you, for our viewers, really. Well, before I close up, I wanted to also ask you, and invite our viewers, if they have any specific questions that they might want, would you be willing to come back out again and answer those questions for us?
Absolutely. I look forward to that. If your viewers and your listeners are able to submit to you some questions, I'll be glad to research them if necessary and answer them then, or just jump back on and answer quite a few questions. This is
Awesome.
Having the ability to reach many people is something that I think is a valuable thing.
Great. So we'll put something out there for our viewers to definitely submit some questions, hopefully in the next few days, and then we'll invite you back out to answer those questions. Also, since you are local and a lot of our viewers are local, of course, we also have people from other states as well. But if somebody wanted to consult with you, if they don't have a financial advisor, or if they're in the process of looking for one, we'll have your contact information, of course, so that they can contact you, and hopefully, you can help them if that's a possibility. We'll do that. And so essentially just wanted to leave it with you as far as if you have any closing comments, and then we'll wrap it up.
This was exciting. Thank you so much for having me. Our office is here in Maitland, Florida, and I'll give you all of our contact information as far as phone and email. And my branch teammate here is Debbie Somerville, so she fields all of our calls and schedules our meetings. Your viewers can call in, email in, schedule a time to speak. Normally, obviously, we conduct in-office meetings. That's not happening right now, but we can do everything we could do in person, we can do by phone.
Awesome.
And by conference, so by virtual. So we can get everything done, answer, and more importantly, we can answer all of their questions, and we can get down into more specific detail into their situation, which is really what excites me, helping people plan for their investments in their future. We love doing that. I love doing that.
Awesome. And Dwayne, I don't know if you want to answer this one right now or if you want to do this for the next one, but I usually would love to hear of your recommendations, maybe like your top 2 or 3 best books or podcasts or what have you on investing for those investors who are maybe, either just getting started or are looking to just increase their knowledge. Any recommendations along those lines? I'll leave it up to you if you want to share that now or if you want to do that in the next call.
Sure. Well, there's 2 books that I've been referencing that I read a while back and I jumped back into over the past week. And one is called The Compound Effect, which is actually not about investing, by the way, not specifically, but it really talks about how there's real power in doing the same things over and over again with diligence. And that's where you see the results. Concentration and focus on the long term. And the second recommendation would be a book called Thinking in Bets.
I'm reading that right now.
Are you? What do you think?
You know what? I'm not that far deep into it, but I
Okay.
just from the initial chapters, I'm hooked in the sense that, what I would have never thought that someone who, like the author talks about the fact that, she she never thought she was going to be be a poker sensation, right? I mean,
Right.
that's pretty exciting. I don't know anything about that, so I'm looking to get deeper into it. I tend to
Sure.
read multiple books at the same time, so any one book sometimes pulls me for a longer period. But
Right.
yeah, it's on my shelf.
I would be curious what you think of that. I liked it because it forces us to think that it's all about rational decision making, not knee-jerk decision making, and then letting the result tell you if it was a good decision or not. That's
Right.
kind of the danger we all pull ourselves into, that I made a good decision because the result happened to be good. That's not how we should be executing decisive thoughts in our life, in our career, in our business, or with our families. We should
Sure.
really be much more thorough in how we're making a decision. And when we're assessing whether a decision was good or not, just using the result of the decision is probably dangerous as well.
Right. Absolutely. I think that's a great premise. Oh, well, that's awesome, man. So the compound effect and thinking in bets, great recommendations. I have not read the compound effect, so I'm going to look into that one myself. And
Absolutely.
Dwayne, as always, thank you so much for your time and for your knowledge that you've shared with us here today. And we look forward to having you back. And we wish you, a great, a safe and healthy day and days to come, and lots of prosperity.
Thank you so much. Thanks for the opportunity, and I look forward to the next one.
All right, sounds good. Thanks, Wayne.
Okay, bye-bye.
Bye bye.